Hi everybody, and welcome back to video number 2 in chapter 1. And when we left off, we were looking at fixed costs and the relevant range. The relevant range of activity pertains to fixed costs as well as variable costs. For example, office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. So fixed costs are going to increase in a step fashion at a rate of $30,000 for each additional 1,000 square feet that we need. So that would suggest we have this step function as it's shown here. So we can make, here's our square footage, and here is our rent costs in dollars, depending on what level of activity we need to make. We might start out at 1,000 square feet, but then as we need to make our products, make more of our products, that could change to 2,000 or 3,000 square feet. Okay, so behavior of costs within the relevant range. For variable costs, in total, variable costs increase and decrease in proportion to the change in the volume or activity level. So variable cost per unit remains the same, whereas fixed cost, the total fixed cost, is not affected by changes in the activity level within the relevant range. But the more we make, the fixed cost per unit will decrease as that activity level rises and increases as the activity level falls. Okay, which of the following costs would be variable with respect to the number of ice cream cones sold at Baskin-Robbins shop? There may be more than one correct answer. Okay, which would be variable? The cost of lighting of the store, alpha. Bravo, the wages of the store manager. Charlie, the cost of ice cream. And delta, the cost of napkins. I think it's going to be Charlie and delta. The cost of ice cream, the more ice cream cones we sell, the more ice cream we will use, and the more variable costs we will incur. Similarly, with napkins, the more customers I have, the more napkins I'm going to need. And that will be a function of how many ice cream cones I sell. Whereas the wages of the store manager is fixed, the cost of lighting the store is fixed. Okay, mixed costs contain both a variable and fixed element. So consider an example of a utility cost. Here we have a fixed monthly utility charge. But as we use kilowatt hours, that mixed cost increases above that fixed cost component. The other example that I use to illustrate this point is our telephone charges. Every line that I get in the plant costs me $15, let's say. So it's kind of like a rental cost of that line. But then when people use it and I have long distance charges, those are variable costs. So I have a mixed cost on that as well. Okay, so we have a formula to express that mixed cost line. And it's shown here. Y here is the total mixed cost. And it consists of alpha here, which is your total fixed costs, and it's called the vertical intercept line, if you like to look at it that way. And then bravo is the variable cost per unit of the activity, the slope of that line, and then x-ray here is the level of activity. So I think that looks a little more intimidating than it really is when we go to apply it. So here is an example. If your monthly fixed utility charge is $40, your variable cost is 3 cents per kilowatt hour. and your monthly activity level is 2,000 kilowatt hours, what's the amount of your utility bill? So if we plug those amounts into the formula, here's our fixed costs plus the kilowatt hour charge times the number of kilowatt hours. And if we add that together, we get $100. Okay, now we're going to take a look at cost classifications that we use in making decisions. Relevant costs and irrelevant costs. Now, decisions involve choosing between alternatives, naturally, and the goal of making decisions is to identify those costs that are either relevant or irrelevant to the decision. So to make those decisions, it's essential that we have a grasp on those concepts of differential costs and revenues, opportunity costs, and sunk costs. So a differential cost, or incremental cost as I like to call it, are the difference between cost between two different alternatives. Then on our second bullet point here, a difference in revenue between two alternatives is called differential revenue. And then under the third bullet point, both the first bullet point and the second bullet point are always relevant to decisions. Differential costs can be either fixed or variable. An opportunity cost is the potential benefit that is given up when one alternative is selected over another. Those costs are not usually found in the accounting records, but they are relevant costs that must be explicitly considered in every decision. So, what is the opportunity cost you incur by attending class? Well, I think the answer to that would be that you would have charge for getting to class, your gasoline charge, that kind of thing. Okay. A sunk cost is a cost that's already been incurred and cannot be changed by any decision made now or in the future. If you've invested in a piece of equipment, for example, you're not going to be able to change that because you already purchased that piece of equipment. It cannot be changed by any decision, and they're not differential costs. So because only differential costs are relevant in a decision, sunk costs are irrelevant and should always be ignored. So, suppose you are trying to decide whether to drive or take a train to Portland to attend a concert. You have ample cash to do either, but you don't want to waste money needlessly. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision on whether you drive or take the train to Portland? And I think pretty obviously, yes, the cost of the train ticket is relevant. Now, again, suppose you're trying to decide whether to drive or take a train to Portland to attend a concert. And you have ample cash to do either, but you don't want to waste money. Is the annual cost of licensing your car relevant in this decision? And I think you would just intrinsically know that no, the licensing cost is not relevant. Now, suppose your car could be sold now for $5,000. Is this a sunk cost? It could be sold. So no, it's not a sunk cost because we haven't sold it for $5,000. Now, we'll take a look at preparing income statements for a merchandising company using the traditional and contribution margin formats. Here is the traditional format, which is required under external reporting by GAAP. We have our sales, we have cost of goods sold, the gross profit or gross margin, back out our selling and administrative expense, and we get our net operating income. So that's fine. But from the standpoint of a contribution format, you'll notice it's presented a little differently. We have our same sales, but our variable expenses are $60,000. That would mean that $10,000 of that was fixed, right? And my contribution margin is $40,000. My fixed expenses go up by that $10,000 that was included in these cost of goods sold, but not included in these variable expenses in the contribution margin format. But our net operating income would be the same, $10,000. This is important, and it's used primarily by management to make business decisions. Okay, the contribution income statement format is used as an internal planning and decision-making tool. We're going to use this for a lot of different things in this course. Number one, cost volume profit analysis, which we'll get to in Chapter 6. Number two, segmented reporting of profit data. We'll get to that in Chapter 7. Budgeting. We'll get to that in Chapter 8. And number 4, special decisions such as pricing or make or buy analyses, which we will get to in Chapter 11. All right, that concludes Chapter 1. And when we return, we'll take a look at Chapter 2. Until that time, bye for now.